For years, the silver market moved as if the physical world barely mattered. Prices rose and fell on paper trading, futures contracts, and policy expectations, while the underlying metal itself remained largely ignored. Analysts debated inflation, interest rates, and central bank signaling, confident that silver would behave the way it always had. Stable, contained, predictable. That assumption has quietly broken. What is unfolding in silver right now is not volatility in the usual sense. It is not speculation, and it is not a temporary imbalance that resolves with a press conference or a rate decision. It is the moment when physical constraints, long hidden beneath layers of financial abstraction, begin to assert themselves. Something fundamental has shifted inside the silver market. Not suddenly enough to trigger panic, but decisively enough to change behavior. And once behavior changes, prices eventually follow. At first glance, nothing appears dramatic. Screens still show trades clearing. Contracts still settle. Market commentary continues to focus on macro trends rather than metal flows. But beneath that surface, the relationship between paper silver and physical silver is starting to strain. Silver is not just another financial asset. It is a physical metal with a dual role: monetary history on one side, industrial necessity on the other. Unlike purely financial instruments, it cannot be created on demand. It must be mined, refined, transported, and delivered. Every ounce that exists comes from a physical process that obeys real limits. For a long time, those limits didn't matter. Or at least, they didn't appear to. Financial markets were able to smooth over shortages, delay signals, and suppress tension. Inventory buffers absorbed stress. Paper claims substituted for metal. The system appeared balanced. That balance is now weakening. What makes this moment different is not a sudden surge in interest or a speculative rush into silver. It is the growing realization that physical silver availability is no longer as flexible as markets assumed. When supply becomes rigid and demand remains embedded, pressure does not release gradually. It builds, and pressure in a physical market does not disappear just because it is ignored. This is not a story about silver becoming fashionable again. It is a story about limits, about what happens when a metal that underpins modern industry, energy infrastructure, and technology begins to behave less like a financial abstraction and more like the physical resource it has always been. Most participants haven't recognized this yet. Many won't until much later. But the early signs are already present, quietly reshaping decisions behind the scenes. And this is only the surface of what's starting to change in silver. Every market is built on an assumption. And in the case of silver, that assumption has always been simple. If the price rises enough, supply will respond. More mining, more refining, more metal entering the system. It's the belief that higher prices eventually solve shortages. That belief only works when supply is elastic. Silver supply is not. Unlike commodities that can ramp production quickly, silver is largely produced as a byproduct. It comes out of mines that are primarily focused on other metals. That means higher silver prices do not automatically lead to higher silver output. Decisions about production are driven by copper, zinc, lead, and gold economics, not by silver itself. This distinction matters far more than most market participants realize. For years, it didn't matter because demand pressure was muted and inventory buffers were sufficient. When industrial use increased, above-ground stockpiles absorbed the difference. When investment demand spiked briefly, paper markets smoothed the shock. The system appeared flexible. That flexibility is now fading. As physical silver demand continues, driven by electronics, energy infrastructure, and manufacturing, the supply side is finding it increasingly difficult to adjust. Mines cannot simply decide to produce more silver. Refiners can only process what they receive. And new capacity takes years, not quarters, to bring online. At first, this imbalance is almost invisible. Shipments continue to arrive. Contracts are honored. Manufacturers assume delays are temporary. The market treats each disruption as an isolated issue rather than a pattern. Everything still looks stable on the surface. But stability built on buffers is temporary by definition. As inventories are drawn down, the margin for error disappears. When replacement silver cannot arrive fast enough, the system loses its ability to absorb shocks quietly. At that point, price becomes the only remaining tool to ration access. Not because of speculation, but because there is no alternative. This is when behavior begins to change. Buyers who once relied on just-in-time delivery start securing metal earlier. Manufacturers lock in supply for longer periods. Wholesalers become cautious about what they release into the open market. Each defensive move removes physical silver from circulation, tightening conditions further. The key point is this: none of these actions are driven by panic. They are driven by risk management, rational responses to uncertainty. And when rational behavior spreads through a constrained physical market, it accelerates the imbalance rather than correcting it. This is why silver shortages do not announce themselves loudly. They develop quietly behind closed doors, in procurement offices and supply contracts, long before the price reflects what's happening. By the time the broader market notices, the underlying conditions are already set. Silver is still trading. Paper markets still function. But the relationship between paper silver and physical silver is no longer as comfortable as it once was. And when that relationship begins to strain, the consequences do not stay confined to the metal itself. They move outward into pricing, into industrial margins, and eventually into how silver is valued altogether. That's where the real shift begins. The turning point in silver did not arrive with a dramatic announcement or a sudden spike in price. There was no headline declaring a shortage, no emergency meeting that forced markets to pay attention. That absence of noise is precisely why the shift took hold so effectively. Systemic changes in physical markets rarely begin in public view. They begin in paperwork. In silver's case, the pressure started with administrative decisions that altered how the metal could move through the global supply chain. Licensing rules tightened. Export conditions changed. Compliance requirements became more restrictive. On paper, each adjustment appeared minor, technical, and procedural, nothing that would normally concern traders or investors watching price charts. But silver does not move freely through markets on price alone. It moves through a narrow set of refining, processing, and distribution channels that are already concentrated and capacity constrained. Small changes at those choke points have outsized effects downstream. As weeks passed, the impact became harder to dismiss. Physical silver shipments began to slow. Replacement supply took longer to secure. Refiners outside restricted regions continued operating at full capacity, but they had no ability to expand output quickly enough to offset the disruption. Logistics stretched. Premiums began to appear, not on trading screens, but quietly, through private negotiations and long-term supply discussions. This is the moment when the silver market begins to reprice risk. Not because participants fully understand what is unfolding, but because they sense that something fundamental has changed in the flow of physical silver they depend on. Availability becomes uncertain. Delivery timelines lengthen. Suppliers become reluctant to guarantee volume months in advance. That uncertainty forces behavior to shift. Companies that once optimized for the lowest possible cost now prioritize access to physical silver above all else. They accept higher prices to secure delivery. They sign longer contracts. They pull future demand into the present to protect themselves from disruption. Each defensive decision removes more physical silver from the open market, tightening supply further. And because the original change was administrative rather than economic, the market receives no clear signal about how severe the situation truly is. There is no obvious endpoint, no timetable for reversal, no mechanism that can compel coordination across jurisdictions and supply chains. By the time this reality becomes widely recognized, silver is no longer trading as a normal industrial commodity. It is trading as insurance against interruption. This is how a slow imbalance in silver turns into a sudden shock. Not because a new discovery was made, but because a quiet decision forced the market to confront a physical reality it had postponed acknowledging. Once that recognition spreads, the price of silver is no longer set by equilibrium models or historical averages. It is set by urgency. And urgency does not wait for confirmation. Because the moment access to physical silver is questioned, every participant is forced to assume the worst and act accordingly. And that is when another group, watching all of this from a very different position, begins to matter far more than the silver market expected. Long before the pressure in silver became visible to the broader market, a small group of participants had already adjusted their behavior. They did not do so because they expected a sudden breakout in price, and they did not rely on dramatic forecasts or public narratives. They acted because they understood how physical silver shortages actually develop, and how long markets can ignore them before being forced to respond. These participants were not chasing momentum. They were securing metal. While most attention remained focused on futures pricing and macro commentary, this group paid attention to inventory flows, delivery schedules, and contract terms. They watched how much physical silver was leaving the system and how little was being replaced. They noticed that refiners were running at capacity with no meaningful ability to expand. They saw that administrative friction was not being resolved, only normalized, and they acted accordingly. Their accumulation was quiet and methodical. It did not show up in daily volume spikes or headline-grabbing trades. It appeared in long-term contracts, private offtake agreements, and steady withdrawals from available supply. Warehouses filled. Custodial arrangements expanded. Ownership consolidated without attracting attention. This behavior was made easier by the prevailing narrative surrounding silver. For years, silver was treated as an afterthought, too volatile for serious monetary consideration, too abundant to be scarce, too industrial to be a store of value. Price suppression, whether intentional or structural, reinforced this perception. Each failed rally confirmed the belief that silver would remain contained. That belief created the perfect environment for accumulation. Low prices discouraged new investment in silver production. Exploration budgets remained limited. Refining capacity stayed tight. Meanwhile, physical silver continued to be absorbed quietly by those who understood that the market's apparent stability was built on fragile assumptions. The key advantage these participants possessed was time. They were not forced to monetize quickly. They were not dependent on short-term price appreciation. They could wait while paper markets continued to dominate price discovery and while broader interest in silver remained subdued. Each year of indifference strengthened their position. Eventually, the conditions that made suppression effective began to erode. As physical tightness increased and administrative friction persisted, maintaining downward pressure on price became less useful and more costly. Large paper positions that once capped rallies lost their effectiveness as fewer sellers were willing to part with physical metal at prevailing prices. This transition did not occur all at once. It unfolded gradually. Resistance levels that had held for years began to weaken. Selling pressure diminished. The market did not surge because demand exploded. It moved because supply was no longer being offered as freely. To outside observers, it looked like a sudden change in behavior. To those tracking physical silver flows, it was the natural outcome of years of accumulation meeting a tightening supply environment. At that point, silver stopped behaving like a market that needed to be controlled. It began behaving like a market that was being allowed to respond. And when price is finally permitted to reflect physical reality after a prolonged period of suppression, the adjustment is rarely smooth. It is abrupt, uneven, and unsettling for those who relied on the old assumptions. This realization carries an uncomfortable implication. The system did not lose control of silver unexpectedly. Control was relaxed when it no longer served the interests of those who understood the structure of the market best. And when the participants with the deepest insight into physical silver stop resisting higher prices, it is rarely because the move is over. It is because the conditions that made resistance possible are already gone. When silver finally began to move, it did not do so in a controlled or orderly way. It did not pause at familiar levels or respond to traditional technical signals. Instead, it pushed through long-standing price ceilings with surprising speed, leaving much of the market scrambling to explain what had just happened. That behavior was not emotional. It was structural. Silver did not reprice violently because demand suddenly exploded. It repriced violently because the market had delayed the adjustment for too long. The conditions that should have been reflected gradually in price were absorbed quietly instead, through inventory drawdowns, private contracts, and suppressed signals, until the system reached a point where it could no longer contain the pressure. For years, silver pricing relied on mechanisms designed to smooth volatility. Futures markets absorbed selling. Paper supply expanded when physical supply could not. Large positions capped rallies and reinforced the perception that silver was abundant and controllable. This created the appearance of stability, but it also prevented small imbalances from correcting themselves naturally. Stability, in this case, became a form of compression. As physical silver became harder to secure, the gap between paper availability and real metal widened. But because that gap did not immediately affect settlement or delivery obligations, it remained invisible to most participants. Price stayed anchored while pressure accumulated underneath. When that anchor finally slipped, there was nothing left to slow the move. Physical sellers had already stepped back. Inventory buffers were thin. Replacement supply was delayed. Refining capacity was fixed. The usual sources of resistance simply weren't there. So when buyers were finally forced to compete for available silver, price had to adjust all at once. This is why the move skipped levels. Silver was not discovering a new equilibrium. It was catching up to one that already existed in the physical market. The violence of the adjustment reflected the amount of time the market spent ignoring reality, not a sudden change in fundamentals. Once price begins to reflect physical scarcity, traditional reference points lose relevance. Historical ranges no longer apply. Previous highs stop functioning as resistance. The market is no longer negotiating between willing buyers and sellers. It is reallocating limited supply under pressure. That reallocation does not happen gently. Each price increase forces new decisions. Industrial users reassess margins. Wholesalers reconsider release schedules. Investors who once relied on paper exposure question whether it offers the protection they assumed. Every reassessment feeds back into demand for physical silver, reinforcing the cycle. This is why violent repricing in silver rarely marks the end of a move. It marks the point at which the market finally acknowledges that the old framework no longer works. That paper mechanisms can delay, but not prevent, a reckoning. And that once physical reality reasserts itself, the adjustment tends to overshoot rather than resolve neatly. The most important consequence of this shift is not the price level itself. It is what that price level does to everything built on the assumption of cheap, readily available silver. Because once silver resets structurally, it stops being a passive input. It becomes a constraint. And when a critical metal becomes a constraint, the impact spreads far beyond the silver market alone. Once silver reprices structurally, the impact does not remain confined to the metal itself. It moves outward into balance sheets, production schedules, and long-term planning assumptions that were built on the idea that silver would always be affordable and available when needed. This is where the real damage begins. Silver is deeply embedded in modern industry. It sits inside electronics, energy infrastructure, medical devices, and manufacturing processes that cannot simply switch inputs without cost or delay. For many of these applications, silver is not optional. It is essential. And because it represents a relatively small portion of total product cost, it was often treated as a background input, important but not threatening. That perception changes quickly when price resets. At first, higher silver costs appear manageable. Margins tighten slightly. Procurement teams renegotiate. Companies assume they can pass incremental increases downstream. But this framing misses the real issue. The problem is not the absolute price of silver. It is the loss of predictability. When silver prices become volatile and physical availability uncertain, planning becomes difficult. Contracts signed months earlier no longer reflect current costs. Production forecasts lose accuracy. Inventory strategies that relied on just-in-time delivery suddenly carry risk. For manufacturers operating on thin margins, this is not a minor inconvenience. It is a structural challenge. Silver-intensive industries face a choice: absorb higher costs and compress margins, raise prices and risk demand destruction, or reduce output. None of these options are attractive. And because many firms across the supply chain face the same constraints simultaneously, the ability to shift the burden elsewhere is limited. This pressure begins to show up quietly. Capital expenditure plans are delayed. Expansion projects are reconsidered. Research and development budgets are tightened. What looks like prudence at the firm level accumulates into stagnation at the system level. Financial markets respond accordingly. Valuations are not based on current earnings alone. They reflect expectations about future stability and growth. When a key input like silver becomes structurally more expensive and less reliable, those expectations have to be revised. Growth projections flatten. Risk premiums increase. Multiples compress. This is not a judgment about management quality or execution. It is a reassessment of the environment. As silver costs ripple through industrial supply chains, the impact becomes uneven. Companies with pricing power, diversified inputs, or large cash reserves can adapt more easily. Those without flexibility face increasing strain. Some consolidate, others exit, a few fail. This process is often misinterpreted as cyclical weakness or poor decision-making. In reality, it is the system reallocating stress in response to constraint. The important point is that none of this reverses quickly. Even if silver prices were to stabilize temporarily, the loss of confidence in availability lingers. Companies redesign supply chains for resilience rather than efficiency. They hold more inventory. They sign longer contracts. They accept higher baseline costs in exchange for security. Those adjustments raise the floor for silver demand and reduce the amount of metal available to the open market, which means the pressure that caused the repricing does not dissipate. It becomes embedded. At this stage, silver is no longer just a cost variable. It is a strategic input that shapes decisions across industries and markets. And once that shift occurs, the next question becomes unavoidable. What happens when financial leverage, built on assumptions of stability, meets a physical market that no longer behaves predictably? As pressure builds in the physical silver market, it does not stay confined to miners, refiners, or industrial buyers. It moves into financial structures that were built on the assumption that silver would remain liquid, predictable, and easily hedged. This is where leverage begins to matter. Modern silver markets are deeply financialized. Futures contracts, options, swaps, and structured products allow participants to gain exposure without ever touching the metal. Under normal conditions, these instruments function smoothly. They provide liquidity, enable hedging, and stabilize pricing. But they all rely on a shared assumption that physical silver is available when needed. When that assumption weakens, leverage stops being neutral. It becomes destabilizing. As silver prices reprice rapidly and availability tightens, margin requirements rise. Positions that were comfortably funded under stable conditions suddenly require additional collateral. Participants who used leverage to enhance returns are forced to make decisions quickly: add capital, reduce exposure, or exit entirely. This process is mechanical, not emotional. Risk managers do not debate long-term fundamentals. They respond to volatility and exposure limits. When silver moves sharply, risk models adjust automatically. Positions are cut not because investors have lost conviction, but because rules require it. That forced selling introduces a paradox. At the same time that physical silver is becoming harder to obtain, paper silver is being liquidated. Prices can experience sharp swings, not because supply has improved, but because leveraged participants are reducing exposure under pressure. This creates the illusion that the market is unstable or irrational, when in fact it is responding exactly as designed. The deeper issue is what happens next. As leveraged positions unwind, confidence in paper exposure erodes. Participants begin to question whether futures and derivatives provide the protection they were meant to offer. If delivery becomes uncertain, paper claims lose their appeal. That shift changes demand patterns. Some investors reduce silver exposure entirely. Others move in the opposite direction, seeking physical silver precisely because paper instruments no longer feel reliable. This divergence strains the relationship between paper pricing and physical availability even further. Meanwhile, institutions that facilitate leverage face their own constraints. Clearinghouses adjust requirements. Brokers tighten terms. Liquidity becomes more selective. Access to leverage narrows at the exact moment volatility rises. This tightening amplifies price moves rather than containing them. Silver does not need a large speculative base for this effect to matter. Even modest leverage, when layered on top of a constrained physical market, is enough to introduce instability. And because silver trades across multiple venues with varying rules and settlement structures, coordination becomes difficult. What emerges is a fragmented market. Prices in different forms of silver, spot, futures, physical bars, industrial supply, begin to diverge. Premiums rise in some channels, while paper prices fluctuate elsewhere. Participants choose the venue that best suits their risk tolerance, not the one that best reflects underlying conditions. This fragmentation is a warning sign. It indicates that the market is no longer unified by a single clearing price. Instead, it is being pulled apart by competing demands: liquidity versus certainty, leverage versus ownership. Once this dynamic takes hold, it becomes difficult to reverse. Leverage can be reduced, but confidence takes longer to rebuild. And in a market where physical silver availability is already under strain, reduced confidence feeds back into demand for the metal itself. The result is a reinforcing loop. Physical tightness increases volatility. Volatility triggers leverage reduction. Leverage reduction undermines paper markets. Undermined paper markets push participants toward physical silver. Physical demand tightens supply further. This is how stress in silver spreads beyond the metal and into the broader financial system. And it is why what happens next is not determined by sentiment or forecasts. It is determined by how institutions respond when the tools they rely on begin to behave unpredictably. That response marks the next stage in silver's transformation. When pressure in the silver market becomes impossible to ignore, attention naturally turns toward institutions that are expected to restore order. Governments, central banks, regulators. The assumption is familiar. If markets become unstable, intervention will follow and stability will return. That assumption works best in purely financial crises. Silver does not fit that category. Policy tools are designed to influence money, credit, and confidence. They are effective when markets freeze due to fear or liquidity shortages. Interest rates can be adjusted. Liquidity can be injected. Regulations can be relaxed. Time can be bought. But silver's problem is not financial in origin. It is physical. Lower interest rates do not produce more silver. Liquidity injections do not increase refining capacity. Regulatory adjustments cannot compress the years required to develop new mining projects or expand processing infrastructure. Policy can influence demand at the margins, but it cannot override the physical constraints that govern supply. This is where intervention begins to lose effectiveness. In some cases, policy responses actually worsen the imbalance. Stimulus measures designed to support growth increase industrial demand for silver at the same time supply remains fixed. Subsidies aimed at accelerating energy transitions raise consumption without addressing availability. The result is additional pressure on an already tight market. Attempts to manage price directly carry their own risks. History shows that when governments try to suppress prices in the face of real scarcity, availability deteriorates rather than improves. Suppliers withdraw. Black markets emerge. Transparency declines. The problem becomes harder to measure, not easier to solve. Silver has experienced versions of this dynamic before. Each time, policy delayed recognition rather than resolving the underlying issue. And each delay made the eventual adjustment more abrupt. Markets sense these limits quickly. Participants pay close attention not just to what policymakers say, but to what they can realistically accomplish. When it becomes clear that intervention cannot restore physical balance, expectations shift. Supportive measures stop being reassuring. They are reinterpreted as confirmation that the situation is serious. This psychological shift matters. As confidence in policy solutions weakens, participants stop waiting for rescue. They stop assuming conditions will normalize on their own. They adjust behavior instead. They secure supply. They hedge risk more aggressively. They shorten planning horizons. Silver, in this phase, becomes a mirror. It reflects the boundary between financial authority and physical reality, between tools designed to manage expectations and materials that obey geological and industrial limits. The metal does not respond to reassurance. It responds to availability. This realization forces a broader reassessment. If silver, an essential input across industries, cannot be stabilized through policy alone, then other assumptions about control come into question as well. Confidence in smooth transitions, predictable costs, and coordinated responses erodes. At this point, the conversation shifts away from fixing the problem and toward living with it. That shift marks a turning point. Because once markets accept that silver constraints are not temporary or policy-induced, behavior changes permanently. Planning becomes defensive. Resilience replaces efficiency. Ownership becomes more important than exposure. And that sets the stage for the final phase of silver's transformation, one that extends beyond price movements and into how silver is understood within the system itself. Once markets accept that silver constraints are not temporary and not solvable through policy, behavior begins to change at a deeper level. This is the point where silver stops being treated primarily as an industrial input and starts being treated as protection against disruption. The shift is subtle but decisive. Industrial users do not abandon silver. They cannot. Instead, they change how they interact with it. Procurement strategies evolve from cost optimization to risk minimization. Access becomes more important than price. Continuity becomes more valuable than efficiency. This is where silver's role begins to transform. Companies that depend on silver for critical components start holding more inventory than they once considered reasonable. They lock in longer-term supply agreements, even at unfavorable prices. They accept higher carrying costs to reduce exposure to interruption. What looks inefficient under old assumptions becomes rational under new ones. At the same time, a different class of participant becomes more active. Investors who once viewed silver primarily through price charts and macro correlations begin to reassess its function. Silver is no longer just a trade or a hedge against inflation. It becomes a way to reduce reliance on systems that are showing strain, paper markets, leveraged exposure, and complex supply chains. This is not speculative enthusiasm. It is strategic repositioning. The key difference is intent. When silver is treated as insurance, it is not bought to be sold quickly. It is acquired to be held. That changes market dynamics dramatically. Metal that enters long-term storage does not return to circulation easily. It does not respond to short-term price signals. It tightens supply persistently rather than temporarily. This behavior reinforces itself. As more participants seek certainty through ownership, availability in the open market declines further. Premiums become normalized. Delivery times extend. The cost of waiting rises. Each of these factors encourages earlier and larger commitments, pulling demand forward and compressing future supply. The result is a market that behaves differently from what most models anticipate. Price no longer reflects marginal buyers and sellers reacting to news. It reflects a collective attempt to secure continuity in an environment where continuity cannot be guaranteed. Volatility increases not because sentiment is unstable, but because the underlying structure has changed. This is why silver begins to decouple from traditional signals. It stops moving in lockstep with interest rates. It behaves independently of equity cycles. It responds less to forecasts and more to tangible developments in supply and demand. The metal starts to trade on its own terms. This transformation does not require panic or widespread recognition. It unfolds quietly, driven by rational decisions made under constraint. By the time it becomes obvious in hindsight, the opportunity to respond early has passed. Silver's dual nature amplifies this effect. As an industrial metal, it is consumed. As a monetary metal, it is stored. When both functions compete under tight supply conditions, the balance shifts. Consumption becomes more cautious. Storage becomes more deliberate. The flow of metal slows. That slowing is the signal. It tells the market that silver is no longer just part of a production process. It is part of a risk management strategy. And once a metal enters that role, its behavior changes permanently. This is not a return to historical norms. It is a transition to a new equilibrium, one defined by constraint rather than abundance. And when silver reaches that point, the final implications extend beyond markets and industries. They reach into how value itself is measured and preserved. By the time silver completes its transformation, the significance of what has happened extends far beyond the metal itself. Silver becomes a case study, one that exposes the boundaries of a system built on abstraction, leverage, and assumed flexibility. Modern financial markets are designed to manage symbols, not substances. Prices move faster than materials. Claims multiply faster than resources. Efficiency is maximized by assuming that supply will always respond if incentives are adjusted correctly. For decades, that assumption held well enough to go largely unchallenged. Silver quietly disproves it. What silver demonstrates is that abstraction works only as long as physical reality cooperates. Futures contracts, derivatives, and settlement systems can smooth volatility, but they cannot create metal. They can delay signals, but they cannot eliminate constraints. Eventually, the underlying material asserts itself. This is why silver's behavior feels unsettling rather than dramatic. There is no single moment of collapse, no announcement that the system has failed. Instead, confidence erodes gradually as participants realize that the tools they rely on are no longer producing the outcomes they expect. Price signals become noisier. Hedging becomes less effective. Planning horizons shorten. Silver exposes the asymmetry between control and reality. Institutions can influence liquidity, credit conditions, and sentiment. They can encourage participation or restrain it. But they cannot dictate geological supply, refining timelines, or industrial necessity. When these forces diverge from financial assumptions, authority gives way to adaptation. That adaptation takes many forms. Markets fragment. Ownership concentrates. Resilience replaces optimization. Participants stop trusting averages and begin planning for extremes. What once looked inefficient becomes prudent. What once looked excessive becomes necessary. Silver does not cause these changes. It reveals them. Because silver sits at the intersection of finance and industry, its constraints propagate outward. When silver tightens, it pressures manufacturing margins. When margins compress, valuations adjust. When valuations adjust, capital reallocates. Each step compounds the next. This is why silver's story cannot be isolated. It challenges the idea that modern systems are infinitely flexible. It challenges the belief that policy can always restore balance. It challenges the assumption that prices alone are sufficient signals in a world governed by physical limits. None of this requires catastrophe. It requires only persistence. As long as silver remains constrained, the lessons it teaches continue to apply. Participants adapt not because they expect collapse, but because they no longer trust smooth outcomes. They prepare not for the most likely scenario, but for the most damaging one. This shift is subtle, but profound. It marks the transition from a system built on confidence and control to one shaped by respect for constraint. From abstraction toward material reality. From efficiency toward resilience. Silver does not need to dominate headlines to accomplish this. It only needs to behave differently enough to force reconsideration. And once that reconsideration begins, it rarely stops at a single market. It spreads. That is the final implication of silver's transformation, and the reason its story matters far beyond price charts. At its core, what has unfolded in silver is not a mystery and not a failure of markets. It is the delayed recognition of a reality that was always present. Silver was never as flexible as its price suggested. The system simply learned how to postpone acknowledging that fact. For years, financial structures absorbed pressure that should have been reflected earlier. Paper markets expanded where physical supply could not. Inventories bridged gaps temporarily. Administrative friction was treated as noise rather than signal. Each layer of abstraction made silver appear more manageable than it truly was. That illusion has now worn thin. The mechanism behind silver's transformation is straightforward. A physically constrained metal, essential to modern industry, was priced as though it were infinitely substitutable and readily available. When administrative decisions restricted flow and supply proved slow to respond, the system had only one way to adjust. Behavior changed first, price followed later. Once access to physical silver became uncertain, the market stopped trading silver as a commodity and began treating it as a strategic asset. Ownership replaced exposure. Continuity replaced efficiency. Urgency replaced equilibrium. This shift did not require panic, nor did it require universal understanding. It required only enough participants to recognize that waiting carried more risk than acting. From that point forward, the outcome became increasingly difficult to reverse. Silver's repricing was not driven by discovery or speculation. It was driven by confrontation, by the moment financial abstraction met physical constraint and was forced to yield. No amount of liquidity, policy support, or modeling could change that interaction. They could only delay it. This is the limit that silver reveals. Governments can influence markets, but they cannot compel metals to appear. Central banks can stabilize currencies, but they cannot refine ore. Financial systems can multiply claims, but they cannot multiply atoms. When these boundaries are reached, prices stop behaving politely. Silver did not break the system. It exposed where the system ends. That exposure carries broader implications. It reminds markets that not all risks are financial. Some are material, some are structural, and some cannot be diversified away once they become binding. From this point forward, silver will not return to behaving the way it did before. Not because conditions are permanently extreme, but because assumptions have changed. Once participants learned that physical access matters more than paper availability, that lesson persists. This analysis is not financial advice. It is an observation about how constrained systems respond when delay is no longer possible. Silver's story is not about profit or loss. It is about recognition, about what happens when a market is finally forced to price the thing it had been ignoring. And when physical reality reasserts itself, it does not negotiate. It simply proceeds.